Chapter 18 introduced the essential principles of real estate investment that every national level real estate candidate must understand. This chapter explained not only how real estate functions as an investment, but also how investors analyze returns, manage risks, calculate tax liability, and choose from various investment structures. Whether working with residential buyers, income property investors, or clients considering alternative investment vehicles like REITs, a real estate professional must understand how investment decisions are made and how they affect long-term financial outcomes. The following summary consolidates every section of the chapter into a single, organized study guide. Investment fundamentals. Investment fundamentals form the foundation of real estate investment. All investments share three central characteristics: risk, investor involvement, and liquidity. Higher risk generally demands higher return. Some investments, such as stock portfolios, require little involvement, while others, including real estate, demand ongoing management. Liquidity varies widely. Real estate is one of the least liquid investment types due to the time required for marketing, financing, negotiation, and closing. Investors pursue rewards such as income, appreciation, leverage, and tax benefits. At the same time, they must manage risks such as market volatility, business failures, inflation, and financial fluctuations. Investors choose among money investments, equity investments, debt investments, and real estate to balance their risk tolerance with potential returns. Real estate as an investment. Real estate carries its own set of rewards and challenges. Investors must evaluate how market conditions, rent levels, vacancy rates, interest rates, and tax law changes will influence income and value. Because property is illiquid, selling may take months, and rush sales often yield lower prices. Real estate also requires hands-on involvement, from maintenance and repairs to tenant management and operational oversight. Yet despite these challenges, real estate historically provides resilient performance, inflation protection, and long-term appreciation. Real estate investment entities, investors, can participate in real estate through several organizational structures. Direct ownership provides full control, but also full responsibility. Syndicates and partnerships allow investors to pool capital. General partnerships share management duties and liability equally, while limited partnerships allow passive investors to contribute capital with limited liability. Real estate investment trusts enable investors to participate in professionally managed commercial real estate portfolios without purchasing property directly. REITs distribute most of their taxable income as dividends and offer liquidity through stock exchanges. Real estate mortgage investment conduits allow investors to participate in mortgage-backed securities, structured into tranches with varying risk and return characteristics. These investment entities give investors flexibility based on their financial goals, expertise, and desired level of involvement. Taxation of real estate investments. Taxation plays a critical role in investment decision-making. Taxable income equals gross income minus allowable expenses, such as repairs, insurance, property taxes, interest, and depreciation. Replacement reserves and loan principal payments are not deductible. Depreciation, or cost recovery, allows investors to deduct a portion of a property's improvement value each year and significantly reduces taxable income. When a property is sold, gain on sale is determined by subtracting the adjusted basis from the amount realized. If gain exists, it may be taxable unless deferred through a Section 1031 like-kind exchange. Mortgage interest is generally deductible, and passive activity rules restrict how passive losses can be used, allowing them to offset only passive income or capital gain at sale. Investment analysis of a residence. Residential property used as a primary residence is a non-income producing investment. Its value lies in appreciation, equity buildup, leverage, and mortgage interest deductions. Appreciation represents the increase in market value over time. which can be calculated in dollar amount or as a percentage. Depreciation cannot be taken on owner-occupied property. When a homeowner sells, tax liability depends on gain, calculated as amount realized minus adjusted basis. The gains tax exclusion allows up to $250,000, or $500,000 for couples, to be excluded from taxation if the ownership and occupancy tests are satisfied. This exclusion makes owner-occupied housing one of the most tax-advantaged investments available. Investment analysis of an income property. Income properties generate annual cash flow and long-term gain. Pre-tax cash flow is calculated by subtracting vacancy loss, operating expenses, reserves, and debt service from gross operating income. Tax liability is based on taxable income, which accounts for interest and depreciation deductions. After-tax cash flow shows the actual spendable income the investor retains after paying taxes. Investment performance is evaluated using several financial metrics, such as return on investment, cash-on-cash return, return on equity, discounted cash flow analysis, and internal rate of return. These tools help investors measure whether a property meets performance expectations and aligns with long-term financial goals. Overall study summary. Chapter 18 teaches that real estate investment requires balancing risk, return, management obligations, tax strategies, and long-term financial planning. Investors must evaluate properties both as physical assets and as financial instruments. Real estate professionals who master these concepts strengthen their ability to guide clients, answer investment-related questions confidently, and support sound decision-making. Understanding investment fundamentals, not just property law, is essential for national exam success and long-term professional excellence. Discussion. Why is real estate considered riskier, yet often more rewarding than many other investment types? Answer. Real estate requires significant management, faces market fluctuations, and is less liquid than most investments. But it also offers strong appreciation, leverage, income potential, and tax advantages that often lead to higher long-term returns. How does depreciation improve the financial performance of income properties? Answer. Depreciation reduces taxable income without reducing cash flow, allowing investors to keep more income after taxes and improving overall return. Why is a 1031 exchange beneficial for investors? Answer. It allows investors to defer capital gains taxes by exchanging investment properties, preserving equity, and enabling continued portfolio growth. How does pre-tax cash flow differ from taxable income? Answer. Pre-tax cash flow measures actual money received after expenses and debt service, while taxable income reflects income after accounting for allowable deductions such as depreciation and interest. Closing remarks. Chapter 18 provides a complete foundation for understanding real estate as an investment. From basic investment theory to advanced income property analysis, this chapter prepares future real estate professionals to work confidently with investors and homeowners alike. Mastery of these concepts is essential, not only for exam preparation, but for professional practice, where investment considerations influence almost every real estate transaction. As you move forward, this knowledge forms a strong foundation for more advanced financial, investment, and valuation topics.